Welcome, everyone. My name is Bob Jablonski. I am a tax professional located outside of Dallas, Texas, and my firm specializes in helping small business owners with a very large focus on real estate agents. In addition, we help taxpayers who have tax problems with the IRS. This is one in a series of taxation for real estate professionals. Remember, the taxes reduce your profits. Higher taxes mean you have less money to take care of yourself and your family and enjoy your life. And one way to reduce those taxes are to make sure you track all of your expenses. You legally maximize them, and you're able to report them accurately. Today, we're going to talk about the benefits of hiring children and other family members for your real estate business or other small business. So some of the benefits: the child's tax rate's likely going to be lower than your tax rate. This earned income is not subject to kiddie tax, if you've ever heard of kiddie tax. And if your child's under 18 and you are a sole proprietor, there's no employment taxes that you're going to need to collect typically. No Social Security or Medicare. So you're going to save there. And then on the parent side, their business is going to get a deduction at their tax rate. So some issues to keep in mind is that first of all, the work has to be done. It has to be real and legitimate. And the work should be age appropriate. Whereas you might not have a job for an infant, even most young children, there's an age appropriate workflow for them, such as they can stuff envelopes and so on. There's almost always something they can do after that initial infancy stage. If they're over 18, you might want them to not be your dependent for certain reasons. And that might be the type of employment you're getting them into, in that they can qualify for their own dependency. That might make sense if they are perhaps at college age and trying to qualify for student aid. On the other hand, you may not want them to be a dependent. You might want to keep their dependency, and you just have to be careful and plan to handle this appropriately when you're in that situation. I'm going to give you an example of saving. So in this example, my assumptions are that the child is going to earn $2,500. There's no other income, and the parent is in a 24% tax bracket. I don't have it here, but they're under 18. So the child's not going to owe any taxes. Remember, they had no other income. The parent in this example is going to save $982.50. And that's 39.3% tax rate, assuming the 24% federal income tax and then the 15.3% self-employment tax that a self-employed individual must pay. And this assumes that there's no state income tax. It could even be higher with a state income tax. Adult family members, especially when it's related to a spouse, you're not going to normally see those tax savings when you're filing jointly. But there is the ability for them to qualify for benefits. For example, retirement plans. Maybe a spouse will be able to qualify for Social Security. Perhaps with a non-spouse, you're going to see certain tax savings, a parent that's living with you, and so on. So there are, options there. Just have to think through it and plan appropriately. I hope you found this helpful. If you did, please like the video, leave a comment if you have anything to add. And if you're interested in a tax professional that works with real estate professionals, call me for a free consultation. I'm at 972-821-1991. Thanks again for listening, and I hope you all have a great day.